Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Jesse Fragale. Thanks for being on the show, Jesse.
Anytime. How's it going, Whitney?
Hey, it's going good. I really appreciate your time, Jesse. Listeners, you've probably seen him on Bigger Pockets doing videos, and he's helping educate people through Bigger Pockets, and we appreciate that, Jesse. But Jesse's a real estate investor and commercial real estate broker, transitioned from student rentals and single-family homes to multifamily apartments, and he's a Bigger Pockets video contributor, as I already mentioned. But Jesse, just in case the listeners don't know who you are, give us a little more about who you are, and tell them where you live as well, because that's going to help build us into our conversation a little bit and what your focus is right now.
Yeah, absolutely. Well, first of all, thanks for having me on, Whitney. It's an honor to be on the podcast. I am in Toronto, Canada. For all of those that are wondering, it is not cold at all anymore down here. So we're getting some nice 80, I guess for Fahrenheit, that'd be 80, 85. We're in the 30s now. So I guess just a little bit of background for me. As you mentioned, I started in student rental properties. That was how I got into real estate. I was living with a buddy in university, and his dad owned the place. And I was like, I'm paying your dad money, or my dad's paying your dad money, and it seems like a pretty good thing you have going on here. He would rent it out to 3 other guys, so it was 5 of us living in a house. And that was kind of the light bulb for me to kind of get into real estate. Just seeing the passive income. Not knowing any of the, the stuff we know now as you advance in your journey. But yeah, that was the first one for me. So I started with one property, and this was a place about an hour. It's called Waterloo, Ontario. It was approximately an hour and a half outside of Toronto. And started with one. And, as I kind of went a couple years in, I started realizing that you could pull equity out. You could, do a cash out refinance to roll into another deal. So I started doing that, and I got up to, in Waterloo, there were 4 properties that I got up in Waterloo, and, like your first car or your first property, every street that they're on. And that was kind of the base of kind of what set me for the next phase in my real estate investing career. So that's where I went from student rentals to condominiums and single family homes. And as I'm sure some of your Canadian viewers or even American, Toronto has seen a condo boom for the last 15, 20 years, and kind of riding the wave of that. I can't say it was all real estate, IQ, but, we were in an up market, and I was basically able to sell those original properties I had and move it towards what I do now. And that's just a focus on apartment buildings and buying multi-res.
So I wanted to ask you though, so you were in college, you were paying that rent to your buddy's father, and it was like, this light bulb went off. Did you finish college or did you do anything towards what you were studying?
Yeah. So it's funny you mentioned that. So I played, usually the story you get in Canada is you play college hockey. So I played college football in Canada. So that's a little bit of a wrinkle, but I did play when I was younger. So the reason I bring that up is I played for 2 years. And then when I had 3 or 4 properties, I was like, something's got to give, and it's not the real estate. So that's when I stopped playing as a varsity athlete and just said, I have 2 things to do right now. I want to focus on finishing school, or my dad will kill me, and kind of pursue the real estate investing career. But to answer your question, I eventually ended up doing a business focused economics. I did my MBA. So I can't say it was specific to real estate. But as an agent, as a broker, it definitely, brought clients in the door. Some of my clients today are ones that I met through my MBA. And so my view on education, and I know it's a mixed bag when it comes to like our industry, especially investors. You get some guys that think it's a total waste of money, and then some guys that think it's valuable. I think it really comes down to the people that you meet, regardless of if it's in a school, if it's in a meetup, whatever it is. But yeah, that's kind of,
No, I appreciate that. Your network is so important to people that you meet. That's awesome. But so you moved past the single family. Now you're focused on apartments, and then keep going. Tell us a little more about what you're doing now to grow this apartment business.
Yeah. So I did something I said I wouldn't do, which was just me being short-sighted. I for the longest time, I tried not to partner because you just get in that mindset. Well, 100% for me sounds great until you realize that partnerships are crucial. And as you see in your business on the syndication side, you can do a syndication without limited partners. It's kind of the bread and butter of the investors. So for me, I was fortunate to meet somebody in my brokerage that focuses on apartment buildings as a broker. So he had never invested in his life, but he had 10 years of experience in brokerage. So he had met all these guys who, like I was mentioning to you before, had these $20 million, $30 million apartment sales. So he was brokering these deals, but he had never invested in one. And I work in brokerage on the office side, so I don't even touch that stuff. So I looked at him. He had a nice credit score, no debt. And I came in with all these properties, debt, but the know-how. And then that was another light bulb moment where I was just like, we get along, we work together. I said, what if we look for a deal together? And that's when I had sold a few of those original places I had. He had, because he had been working, like I said, in brokerage for a while, he had saved up quite a bit of cash. And we said, okay, let's go look for an apartment. So to give you your listeners a bit of context, the apartment world, we were looking for 10 to 15 unit. We ended up getting, as a first one, the 11 unit. But our market, Toronto, downtown, you'd be looking at $250,000 to $300,000 a unit. So was
wow, $300,000 per unit.
Yeah, so that would be your high end. That would be your Manhattan, and then your average stuff is in the low 200s, mid 200s. That was too expensive for us, so we went west, about an hour west of downtown Toronto. Let's call it a Brooklyn to New York. And those started to be a little bit more affordable. You started to see stuff about 100,000 a unit, 115 a unit, which for a lot of, as I'm sure you're aware, as for a lot of American cities, you can get deals much cheaper than that and still have, not be worried about your building and sleep at night. So that was our first one. We went to go see a few places in, it's called Hamilton, an hour west of Toronto. This was his first time. So like I said, he had never invested before. So the first place we came to, it was, even though he had toured properties before, it was a bit of a, it was a little shock for him because you're getting people that, are in areas that you're not normally in. I think the first one we had, this sounds terrible, but the first one we had, we weren't allowed to see one unit. And we realized after that somebody unfortunately had passed away in that unit and didn't want to take us through. So he looked at me and even today, he'll tell me, he's like, I was at a point where I was like, maybe this investing thing's not for me.
So tell me though, the rents that you're getting approximately, at a $300,000 a unit, do you know what those are renting for?
So you always hear the 1% getting kicked around, right? Rent to value ratio. Toronto's tough. Toronto is the way I could describe Toronto, just, from all asset classes, whether it's industrial, retail, office, multi-res, even residential is really our hottest market. It would have to be compared to San Francisco, Manhattan, LA. So let me give you an example in terms of if you bought, so say a condo, because just to back up for a second, in our market, condos, like a lot of cities, they've kind of replaced purpose-built apartment buildings, and we call it the shadow market. And it's basically, people buying condos and renting them out to people. So to give you some context, a $500,000 condo in Toronto, and I'm not going to go into like fancy areas or bad areas, on average, a $500,000 condo could probably get you about $2,000 a month in income. So it's tough. It's tough to make the numbers work at this stage in our market, but also we're seeing cap rates. Institutional multi-res is trading. Some cap rates have been sub 3%. A lot of them, a lot of them are trading in 3%. If there's something over 4%, over 4 or 5%, it's something we'll take a second look at. Not us personally, but as a company. Whereas, if you have a fund behind you, for us, going out to, again, to give you context, where we were looking, then you start seeing 5%, 5.5%. But it also should be mentioned that your debt markets are at, I think you guys are a little bit higher than us right now. Like right now, I could get a mortgage for 2.78 for like a home.
Wow. Yeah.
I think you guys are a little, So it's, yeah, at the end of the day, it really is the treasury bill, the delta between the treasury bill and the cap rate, and seeing where that is. And I've the States is always a little bit higher with the debt, and you have a bit more on the cap rate, except for your lovely tight markets. Yeah.
No, 300,000 per unit. I was like, wow. But then you said sub 3% cap rates. I mean, I don't even know. Well, what are you doing with that?
Not syndicating.
That's right.
Yeah.
That's right. So all right, we'll back up a little bit and continue the story. Somebody had just passed away at this unit. Is that the unit you all purchased?
No, that wasn't the one we ended up going with. We were just down the street from there. Yeah, we were close. Like it would have been, I would argue it would have been a good deal. I don't know if you would say that, but we ended up, it's so interesting how in our industry, it's all about timing, and, sometimes it's about being in the right place to have good luck. So we looked at a unit that was further down, and it's the typical story of, if I knew then what I know now, we would have bought, 100 of them if we could. It was a perfect scenario. Anyways, it was a 11 unit apartment building. The owner had it for a couple of years, but he was an older gentleman. And I had a suspicion, we both did, that I don't think his health was very good. And I think he just kind of wanted to just sell it quickly. So we didn't, it's not like we hammered him on pricing, but you have a motivated seller, the deal, obviously goes a little bit quicker, and you can do things that you couldn't if somebody, is doing a portfolio sale and said, could lose it or could not lose it. So we really dug into that, made sure we did, the usual due diligence, inspections, environmental. The one interesting thing, and as you know, every deal you get something that you learn for the next one. No matter how long you've been in this industry, you have 50, 60-year-olds in our industry that did something on their last deal that they didn't see before, or was a little different example of something they saw before. And for us, we were right beside a dry cleaner. I'm sure you know where this is going. So the ground was like this. So our apartment's here, dry cleaner's here. And I don't know how it works for where you are, but in our province, if you have, I think it's something like 1965, if the dry cleaner comes up in a search prior to 1965, you need to automatically do a phase 2 environmental. And the reason being is they use some chemicals in these older dry cleaners that, for whatever reason, they made in their mighty wisdom, the government made a reason for us to do a phase 2. So we did the phase 1. Basically said that you would need to do a phase 2. So that was a fairly substantial cost. And that was the only time we ever had a retrade on the deal at all. We just wanted to make sure that could, be covered by the owner. And, it's not that we were trying to save money. It was just part of what we needed to do. So long story short, that came up clean. And it's, the rest is history. So we just that.
That's funny. You said it came back clean. Cleaners. Anyway.
Oh yeah. Yeah, it came back. Yeah, dirty. Yeah, I guess. Yeah. So that one was great. And then our whole focus, not to get ahead, but our whole focus after that was raising rents because, and we can talk about this if you'd like. We do not have the most friendly landlord-tenant, or I should say, we don't have the most friendly landlord rules in our cities. So that's our ability to raise rent is not, is probably not where you guys are at with the amount of ease that you have.
So what do you do? What give us a couple of things why is it difficult, and what do you have to do different?
So it's basically the only time that you can raise rent when you are in Ontario. So we have the Landlord-Tenant Act, like most states, cities will have these. Basically, it says that it's not dissimilar from some of the some of the New York State policies, where if somebody moves into your unit and say they're paying $1,000, $1,000 a month, there is a increase that call it the province says you can only raise, and it's usually pegged to inflation. So after every year, we can only raise. This year, it's ridiculously low. It's like 1.8%. And it's so low that do you want to really bother your tenant to say, give me 1.8%? And the answer is you do, because that's your only way over a long time to keep up with those increases. Now, what we do have, the saving grace, is we can mark to market the rents. And what I mean by that is when somebody leaves and a new person comes in, then boom, you can put the rents up. So it actually creates, it's like anything from the government that is supposed to help consumers. There's always a way that it harms somebody, helps somebody, hurts somebody else. And part of the challenge is you have landlords that don't have the upkeep that you normally would if you're getting market rents. And then what you have is you have investors that will basically go to somebody and say, listen, here's $3,000 in cash. You're paying $1,000 a month. Sign this termination agreement. Basically buying them out of their existing unit. Because as you know, if you can raise something, say somebody's paying the building we have is there's somebody paying $570 for a one bedroom. It's like an 800 square foot one bedroom. They're like three times under market. And as you know, if we raise them from 500 to 1,500, you divide that 1,000 by your prevailing cap rate, and suddenly your building value has just gone up a very large amount. So that's why you see these guys coming in and trying to basically have termination, and that's completely legal. And that's what I mean by some of the negative consequences, because
you're going to have that in your underwriting, aren't you? I mean, this is how much we're approximately going to have to pay these tenants to move out.
Yeah. If you had to go in with that perspective. But yeah, and that's what I mean by negative consequences. It's unfortunate. You don't want a scenario where you have landlords coming in as bullies, or trying to strong arm people out of their place, because sure, you could say, well, they're two adult willing parties, but let's be honest. If you're going into, say, a mid to low income area, you're telling some person that spends $700 a month, here's $2,000, they haven't seen, maybe they're paycheck to paycheck, and you've displaced them in some way. So it's, anyways, the way we look at all, and the reason, we talked about cap rates being so low, it's always, in our markets, we very rarely use cap rates aside from comparing properties, because the going in cap is never your stabilized cap, right? Or if you're doing value add, it should be, I guess is a better way to put it. So if we go in and we see under market and it's a 3.2 cap, but if we had all those rents boosted, it's a 7 cap. So that's kind of the way we look at it.
Yeah. And I could see where, people may never move, why would they move when they know they're, if they've been here for 5-10 years, having such low rent. Well, if I move, it's, my rent's going to triple. But then also I could see them wanting to sublease as well. I could see that being an issue. Is it?
So yeah, you could have people that do sublease. Really the challenge so it's funny, what happened in Toronto is they got rid of this rule so there was a rule that said and I should have mentioned this, any apartments built post 1991 were no rent control. So it was in the early 90s trying to incentivize developers who stopped building purpose-built rentals in our market. It was to incentivize them to build them. So they briefly, last year or the year before, they tried to bring that back, that new developments had to be rent control. So all of a sudden you had the big, the RioCans of the world, the Allied, the Brookfield, all of a sudden they're like, maybe we don't want to build these anymore. And to try to tackle our crazy low vacancy, they really cut the developers by, who do you think is pro forma these models? It's these guys that if you tell them that there's rent control and they can only have 2% increases, they're just not going to build them. So you don't solve the housing problem. So that's a whole episode on its own. But yeah, so ultimately for our purposes, it was identifying properties where we could get lifts in the rent, but the rents were high enough that we could go to a lender and be like, can you give us a decent LTV on a property?
Wow. So, there's a difference in, and you and I briefly discussed it, and I know you're not an attorney, but I'd love for us to at least mention it. But how you all hold property in Canada is different than how we're going to hold it in the States. And could you elaborate on that a little bit?
Yeah, sure. So yeah, no, you said it. I'm not an attorney or lawyer, but we've dealt with enough of them, whether it is for clients or for our personal. So I guess the biggest glaring thing, the difference between the States and Canada is the LLC. Correct me if I'm wrong. LLCs in the United States have the kind of dual positive attributes of being able to, number one, have limited liability. If you have somebody that slips and falls and sues you, or number two, you have the ability to be taxed at your personal rate. I think that would be a general kind of overview. We don't have that in Canada. So you have two options. So without complicating it, let's say you and I bought a property. It was a 20-unit apartment building. We could have partnerships as sole proprietors. Now that would have the benefit of us being taxed at our personal rates, but we would have no limited liability. So if somebody sued, we would be personally liable. So the alternative to that is a more expensive alternative, but most most investors hold their properties in corporations. And I think we were talking before, I'm not sure in the States if it's a C or S corporation, but basically the attributes of the corporation is that, that it will have the limited liability protection because it's in a corporation, but it's going to have the double tax issue. So you're going to have passive income in Canada is if you have property held in a corporation is taxed at 53%. Yeah. So
wow, 53%
at the corporate level. So that's not even until you pay yourself out. So you're taxed at the corporate level at 53%. And then if the most efficient way, and if anybody knows a more efficient way, email me, is that you pay yourself dividends through the corporation. And that's the way, there's a bit of a Canadian controlled corporation. If you're paid a dividend, you have an ability to kind of recover a little bit of that cost. Now, the reason a lot of investors, until they get to the level of syndication where you have LPs and GPs and you have a bit of a different structure, the reason most investors don't care as much about the 53% is, as you know, one of the biggest attributes of real estate is you can have positive cash flow and zero tax liability. So for those, gents or gals that are, say, making $50,000 of net income or cash flow, they might have an amortization of $55,000. So effectively, they wouldn't be paying taxes anyways. So that's part of the reason I think that it's not as big of a concern. I know, there are a lot of investors that they just show no income because they have their amortization expense is enough to kind of wipe out whatever cash flow they have. So yeah, that's kind of a bit of the wrinkle. The only other thing I'll mention that's slightly different, and I'm really jealous of you guys in the States, is we have no 1031 exchange. That just doesn't exist. So we are, in my opinion, we're a very buy and hold investor community, whereas I would argue that, and I'd like to get your thoughts on it, but I would argue that you see a lot more velocity in the States because you have the abilities to do these like in kind exchanges that, when you sell something, it doesn't mean you're
That's right.
Tax man.
Yeah, for sure. And for investors as well that are investing with us, they hope for that 1031 exchange when we exit a deal. I mean, that's a big gain.
Yeah.
For them.
Have you done one before, or have you, I'm sure you've had partners that have done them?
I have not personally done a 1031 exchange. I have had partners who have done 1031s, but it's not the most easy thing to have set up, and make happen. It's very difficult to have, investors 1031 in certain ways that has to be set up, but so it's not very easy, but it is an avenue. I've seen lots of people grow fast, and not so much in syndication as much as when they're buying smaller multis.
Yeah. Yeah, that makes sense because the syndication, you just have that extra layer of complication with so many more stakeholders. Right.
Yeah. And what about, I think you mentioned earlier that you're looking for apartments in the U.S. now. Is that right?
Yeah. So, I mean, ultimately, we love the Canadian markets that we've been able to participate in. It's just at the end of the day, it is just very tough to do deals, especially if you're going to want to move into syndication. Like we said before, you want a pref return, even if that means accruing a pref to when you sell it. And in Canada, even, our markets that are pretty, a little bit looser than Toronto, Vancouver, Montreal. Montreal's okay. But anyways, we kind of identified a few places in the States that we'd at least like to take a look at. I think Memphis, Charleston, Savannah, we would make a trip out of it. So we'd probably just fly down and grab a car and, check out some of the local markets. One of, like we talked about, one of the benefits of being an agent is we can just call any of the brokers in our local markets down there and say, hey, you got a Tuesday? Do you want to not make any money for a Tuesday? Yeah.
At least buy you lunch, right?
Yeah, 100%. We'll buy you lunch.
So how does that change? Can you complete a syndication in the States even though you're not a U.S. resident, or would you have an LLC in the States? Or do you know how that would be?
Yeah. So basically, what we did is we talked to. There's a lot of companies in the States as well that deal with cross-border investing, and the long story, without getting into the weeds on it, is it 100% can be done. I don't believe it's a Canadian that creates an LLC. And there's, the tax, I think there's a way, certainly a way to get around the withholding tax when you're investing in real estate. But like you said, I think for us, the most logical way to do it would be to step up to that and buy, say, a 20 unit, 30 unit in an American market, own that and have my partner, I manage it with third-party management, and then kind of layer on the complexity. So because like we were talking about before, once you're dealing with individual returns, limited partners, it definitely starts changing the structure. And I had a few friends that their GP was Canadian in the States, and it was something that they said they'd do again, but they'd really want to make sure that they did it properly. Because I think it's easier, as it seems obvious, if you have a GP that's a local GP, I'm sure that you've dealt with partners of you have dealt with Canadian investors as LPs, which is a little easier than having the Canadian the Canadian as a GP. Yeah,
sounds like it would just be easier for you to just move below the border.
Yeah, I was going to say. Yeah, I got a number of family members in New York, so yeah, maybe that'll just be easier that way. Or I should just tell them to. Maybe I'll capitalize them and tell them to buy a place.
There you go. I just wondered, do you have U.S. buyers that ever contact you looking for property in Canada?
Oh yeah, for sure. On the brokerage side,
yes.
%. Well, first of all, on the leasing side, because we do a lot of leasing because we're downtown Toronto, so the bank towers, office towers, a number of clients are American, and then investors. A lot of money is coming from Korea right now. One of our biggest developments in Toronto is Korean money, Chinese, Hong Kong. I'm sure people know kind of the background and seen a lot of Asian money that has been coming in, but that's been slowing down, I think, a bit recently. But it's interesting from a leasing perspective, and this goes for anybody that has syndicated office, retail, industrial. It's just a very different culture of negotiating. Like, you guys are much more litigious, I think, and not you guys, I don't want to say just you, but the Americans we deal with, oftentimes non-binding LOIs, a million things on behalf of the tenant side that we just say no to, because our office vacancy in Toronto is 1.8%. So Americans come up here and they try to do office deals. It's like, how did we miss that deal? It's like, no, the landlord's being too crazy on this term. And then put this in, we'll get this tenant allowance. And then we're like, we're not going to win on that. And then the landlord just says, yeah, no, I'm not doing this deal. So it's a bit of a culture shock for them. And that's just in virtue of the fact that our markets are so tight right now. So I think we're seeing it all across the spectrum, resi to retail, leasing to acquisition.
Yeah. Well, Jesse, we're going to pivot just a little bit,
Sure.
But tell me what's been the hardest part of this journey, going into the syndication process, or at least apartments, from where you started. What's been the hardest part of that for you?
So it's interesting. I've never viewed any of the challenges that I've had as being something that has been a negative, because over time it's just another thing in your tool belt. Obviously, you don't say that at the time because you lose a deal, it hurts. You have an expense that you didn't expect. But I'm actually, it's this stage in my career, both as an agent and as an investor, that's a challenging time, because we have had the States and Canada, we have had such a good run since the recession. It was a bit of an anemic kind of upward trend, but we're in a place right now where for the last 5 years, everybody's been saying we're in the 9th inning. And trying to find deals where, the question you get every time from investors that say, see me on Bigger Pockets or something, should I get into the market now? Should I wait? Should I get in? And it's tough to answer that question when we're in such a late cycle, or what we perceive as a late cycle. So, and Toronto is a perfect example of that. LA would be another perfect example. If you're in my shoes in Toronto and you have $200,000 of equity with a partner, you're very cautious of putting it in a 3.5% cap rate, property, because you start asking yourself, well, how much lower can it get? And what kind of growth are you going to have with that type of property? So anyways, long-winded way of saying it's the time right now to just, I think we really need to be a lot more disciplined. 10 years ago, and I'm sure you've seen this in markets that you've dealt in, you look back in time and be like, oh man, we could, you could go on online, and you could go on MLS and, just find property.
Throw a dart. Yeah.
Yeah. Or at least you throw a dart, and maybe it's excuse my French, it's not a great property, but it's, it'll have a cash flow positive return. Whereas now we really have to be dialed in to make sure that the fundamentals work.
Right. What's a way that you've recently improved your business, Jesse, that we could apply to ours?
Okay, so a huge one for me was, this is such a boots on the ground answer, but we had in our building, there was a company that does a full retrofit of all your plumbing. So we had our apartment was, for whatever reason, it was like a sieve. There was, we were spending, I think, something like $800 a month, $850 a month on water. And for 11 unit apartment building, it was just way too high. It was eight or 900. I can't remember what the cubic feet was in terms of usage. But like I said before, the one benefit of being a broker, we had access to investors that have dealt with other people on their team. So one of the investors told my partner, said, listen, we use a plumbing guy. And he's like, oh, we don't need a plumber. No. He's a guy that he'll do an audit of your building and figure out, basically you pay him, they do an audit of your building, and then they tell you based on their calculations and what they've seen in similar markets for similar buildings, what type of payback they would get on doing the full installation of all these retrofits. So we now came to the first month of after this retrofit, this probably 2 weeks from now, I'll get the bill. But you just saw, I was just looking at our meter reads, and it was just, boom, like it was just dropped off a cliff. So I'm excited to see what that ends up being. But as you can imagine, if you're getting that kind of help on a 10 unit, 50 unit, 100 unit, it was definitely a win, because I think people don't realize we're talking about raising rents. It's always the first thing people think about. They don't think of lowering expenses, where the value captures is the same.
Yeah, or cutting expenses out completely that are unnecessary. Yeah, no, that's awesome. What about the number one thing that's contributed to your success?
I get this question. The answer I always give, and I think it hasn't changed, is I've identified a little late in my life, but I've identified things that I'm not the best at, the things that I have a challenge with, whether it's, kind of the minutia of an administration or it's some other thing in my life, and just being humble enough to know that that's something that you struggle with, and to make sure, at least if you're going to be bad at it, know and be aware of it, and hire people around you that are good at those things. And that took me a long time to realize, because you get a lot of these kind of books, and you get these influencers that talk about, taking things that you're not as good at and strengthening those areas. Where I think personally, with respect to anybody has a different opinion, I think the other way around. I think you really have to figure out what the things you're very good at, do those 100%, and the things that you aren't, build a team that's great at that stuff around you. And I think that's been one thing that acknowledgement has helped me out quite a bit in the last 5 to 10 years.
I couldn't agree more. Yeah, there's so much opportunity loss as well as you're trying to do all these things when you could have experts around you helping.
Yeah.
So, Jesse, I really appreciate you being on the show, but tell the listeners, how you like to give back.
In terms of what I do with the community, or
just any way you like to give back to the community, or in any way.
Yeah, sure. So I volunteer with Bigger Brothers in Toronto. I'm sure every city seems to have one Big Brothers. I was a big for a number of years, and then my little move to a new town. But I work with them. Junior Achievement. I'm not sure you guys have Junior Achievement.
We do.
Yeah. So I just wrapped up a kind of a high school project with a bunch of kids. It was very conveniently in my office building downtown. So after work, it was once a week. That I think is great. Being a contributor on the Bigger Pockets, although it's not charity. Well, maybe it's charity in a sense, nobody's paying me, but that has been actually one of those things that has been very fulfilling. You see in the comments, people, first of all, you see Bigger Pockets reach. So when I do a video on there and you see like 20,000 viewers, and then you see just, 100 comments, first of all, it makes you humble, because, you didn't do this right. You didn't do that right. But there's also people that for the majority are, thank you so much. Can you do a video on this? Or, I really found something interesting here. Could you help me out with it? And you forget, I think we forget as we get later in our career that the simple things that we now have as habit is new to somebody else. And you can do very little to answer a question of theirs.
Wow. Yeah, well, thanks for that. Thanks for sharing that, Jesse, and how you give back through the videos and stuff as well. We look forward to seeing more of those. Tell the listeners how they can get in touch with you or learn more about you as well.
Sure. So Instagram, I'll post a lot of the videos that we're about to do or the ones we just released. So it's Jay Fragale, JFRAGALZ, or Z for the US listeners. And then on the flip side, my name, I'm sure you'll have it somewhere in the show notes. They can put that into YouTube. That'll probably pull up all my Bigger Pockets videos. And what I'm doing this week is, because there was so many questions about, so to back up, I'm a commercial real estate video contributor. So it's a bit more narrow, but I've gotten so many questions to touch other topics that I finally decided I'll just start a YouTube channel. And I'm hoping to post weekly. So hopefully keep that up. And the reason I wanted to do that, I wanted to start right from the basics, starting to get into investing, building your team, what's a cap rate, just from the baby steps to, hopefully more seasoned bets. So yeah, that's probably the easiest way to find me. And I mean, shameless plug, if you're looking for commercial space in Toronto, you could Google my name and call me at my office.
Sounds good, Jesse. Thank you so much for sharing your story and just apartments in Canada and how how it's so different from the U.S. or things we need to think about if we're thinking about investing in Canada. But anyway, thank you. And I appreciate the listeners as well being with us today and every day. I hope you all will be back tomorrow. I hope your business is growing because of what you're learning on the show and listening to these experts. And if you have questions that you would like me to answer, I'd like for you to go to the Facebook group, the Real Estate Syndication Show, or you can post those questions. You can reach out to me and we'll try to get those questions answered. And especially if you have a specific guest you would like to hear on the show, I'd like to know that as well. But go to LifeBridge Capital and connect there as well, and we will talk to each of you tomorrow.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.